How to find the best Forex trades step by step. In this video, I show you exactly what it takes to find better Forex trades. So let's get into a few recent trade examples and just interesting chart studies. Some of the trades that I took, some of the trades my students took, and let me dissect them for you and help you understand what to look for in a trade. And one of the most important things when it comes to finding trades is the concept of confluence. Confluence means that you are stacking different different signals, different criteria on top of each other. There are many traders who say that candlesticks don't work. There are many traders who say support and resistance don't work. There are many traders who say any or different concepts don't work. And they are right to some degree, because usually what happens is that any one criteria or any one concept is not really strong enough to form a sophisticated trading idea. So you need to stack them on top of each other. When you combine, for example, support and resistance, supply and demand, candlestick analysis, momentum analysis, and a bigger picture approach, then you will find better trading opportunities. If you just use one of those, it's usually not good enough. So confluence is really, really important. And I recommend that you look at your trading strategy right now and your current trading approach and ask yourself how many confluence factors, how many signals, how many criteria do you currently use. And if there's just one, if you are, for example, just trading engulfing candlesticks, then that's probably not good enough. You need to look a little bit beyond that and try to form a holistic, a complete, a robust trading system that works not only in one market condition, but in all market conditions. So here, this was the New Zealand CAD that I traded. Many of my students as well traded. And let me walk you through this. So first of all, this is the daily chart. We will take a look later at 4-hour and 2-hour as well, but you can use those concepts around all the time frames, which is very important. So by the way, what we are going to look at is this market turnaround and how we could have anticipated. I don't like the word predicted, but how can we anticipate that the market is actually going to turn around? And there are many clues that we could have picked up from the charts. So first of all, I like to trade new trends. So whenever I see something like this, which I would call a very extended trend, a very long trend, I will start watching such a Forex pair or any market. I also trade indices or commodities. So whenever I see a strong trend into one direction, I start stalking it and I start looking for clues that the market is turning around. And not only that, I look for specific areas where it would make sense that the market is going to turn around. So when you zoom out, for example, you can see, I guess you can pretty much see it without even drawing a level on it. This is the level or the area that we have talked about. And just using your crosshair here on TradingView, you can see that this area and this area here really nicely lines up. So if we are going to put a horizontal level on it, you can see we capture the lows here, we capture the lows here, and you can even see in the past here it was not really that clear, but here there were a lot of highs as well lining up. So this is really a strong level, and you can see this is the 83 round number, so you even have more of a confluence factor. So let me actually continue this list. So what do you have? An extended trend. We start stalking, hard work, third try, stalking, price. Then we have a big level where it would make sense to see the price turn around. What else do we have? A round number. I'm usually not a big fan of round numbers, but in this case, or well, what is not fan is not the right word, but I usually don't pay too much attention to it because I have other confluence factors, that's so small, that are usually strong enough. So we have extended trend here. We have a big level. The big level falls right at a round number. And let's take a look at the higher time frame perspective. there's something very, very interesting here. Not only do we have a very long trend, and what else do we have here? Here we suddenly have a candlestick confirmation pattern, or several, I would say. So here we have two candlesticks, two weekly candlesticks, this one, and this one that really, really stand out. What does it mean? You have very long wicks. And what do long wicks mean? It means that the market tried to push through this area. The market tried to push into a new low. It tried to make a breakout attempt below the previous lows, also below this low here, which was the most recent structure low. And it got rejected. Not only once, it got rejected twice. So this is very, very important to note. The market was always pushed back up back into this range market here. Twice did the market try to move lower, but there were not a lot of sellers in the market, and the buyers suddenly they got interested again in this market. Suddenly the buyers were strong enough to really be a strong opposition to the sellers that were here driving the market down. By the way, you can also see that here there was also something like this. There was also a wick, but here this happened in the middle of nowhere. It happened in the middle of the range. The trend here was not very long, not very exhausted, or not very extended. So we don't have any of the confluence factors that we needed or that we have that happened down here. So it's a very, very important difference. So we can see, and we can extend this list. What do we have? Candlestick confirmation. Important. And then what else do we have? We can have, and I have been using the RSI for many years, so I don't often put it on my charts, but if you put it on your charts, you will be able to see also a divergence. What is a divergence? Let me just briefly recap. A divergence is when your indicator and the price action do two different things. So here, the market was making lower lows, very, very obviously, a low, a lower low, and another lower low, or two lower lows. But here, the market at this point, the RSI started to making higher lows. What does that mean? It means that the RSI looks much, much deeper into the price action than what most traders do. And the RSI analyzes highs and lows. It analyzes candle sizes, it analyzes closing prices, and it analyzes how many bullish versus how many bearish candlesticks are there really in the market. So the RSI already detected that the market was not as weak anymore. There were not as many sellers anymore. And if we pay a little bit closer attention, we can actually see that. Let me zoom in. Ever since here, this is really where it started, and you can see it. Suddenly, in this example, the market had a strong, not really a strong bullish run, but when we compare to what has happened previously during this trend, it was a very significant change. Here, not a lot of bullish candles we could have observed here, but here suddenly you have more bullish candles and a longer sequence. That's a very, very different thing to note. Then the market was not able to push lower as much anymore. Here, compare this low to this low, the market was just barely breaking lower. Then here again, a strong bullish sequence. During all of this downtrend, we have never seen such a strong bullish push, such a strong bullish candle sequence. So there are little clues that if you pay close attention to the market, you don't necessarily need the RSI if you know how to really read inside those candle structures. But the RSI is a good confirmation tool to have. It's a little bit more of an objective tool, such as any indicator really. So we can come back to our list and we can say, okay, the RSI divergence is also fading momentum. Very, very important. So we have, we have quite a few things here already that are lining up. So what do we need now? To get the final piece of the puzzle, you want to see a break of structure. What is structure break? So when we look at a downtrend and if we remind ourselves of the Dow theory, which has been around for decades and decades and decades, a downtrend is characterized by lower highs and lower lows. And this is what happened here during this downtrend. Sometimes stronger, sometimes less strong. But at no point was this structure here broken during the downtrend. Very, very important. Here you can say, okay, at one point we did have not a high, or at this point I should say, here we did have a higher high, sorry, but the market continued and did make a lower, did make lower lows and lower highs. Also, again, this happened in the middle of nowhere, just between or just inside of this range market here, and there was no confluence that we could have used. So you can see already how you can distinguish between good and not so good trading setups using such an approach. All right, let's take a look at then what happened here at the bottom. At the bottom, we have a low here or a high, and then you have multiple highs here. And then here you have your absolute low, lows, lows, lows. And let me actually clean this up a bit, or otherwise this will get a little bit too messy. And price action traders, they love it clean, I know. So the entry point in this one was a little bit tricky, and you may have ended up with a first losing trade, because here at this point we have all of our confluence factors. We have the extended trend, we have the candlesticks, we have the momentum, the round number, and everything else that we have said so far. And then here the final piece of the puzzle is a structure break. And I really like this example. Let me write it first, or otherwise this will end up in a disaster. Structure break, the final piece to the puzzle. And this is a great example because it's not like a textbook example. The first breakout here, what do we have? We have, first of all, here, higher lows and a higher high. The first time the market was really able to break out of a well-defined sideways range. So very, very nice example. It broke out, have everything going for it, and then what happened? It failed. And that is what will sometimes happen. Not everything works in trading 100% of the time, but in this example, you got a second chance. What was your second chance? When the market made another, higher high point, which was then here. If you use a very wide stop loss, I'm not sure if you would have survived this drawdown because this was quite significant. So let's assume you would have been taken out. And that's not a big issue because very, very often you will get a second chance. In this example, you had your second chance. There were still some sellers left in the market. But once you realize what has happened here, actually, this is where you have the largest bullish candle that we've ever observed during all of this trend. And this trend lasted for several months. So this is clearly something that is now signaling a very, very significant change in the market. Suddenly there are lots of bulls in the market, a lot of buyers. And then this was your second chance because you broke into a new high. And I always like to go with the flow. So here you go with the trend, because the price is making a higher high point. And then you can see what is happening afterwards. The market continued to rally for now a few weeks again. And of course, we are not going to, and that's not really our goal as well. We're never going to pick the absolute low. We are not going to pick the absolute bottom. But we put things together using confluence to form very, very sophisticated trading ideas, to go with the market and to minimize the chances of losing, because what happens is that many traders, they will get involved into the market as soon as the market ticks up. They get very, very anxious and very, very excited. Oh, now the market is resuming, or it's returning and making a new uptrend. I have missed all of this downtrend maybe. So those traders are very, very eager to get always into the market. But you need to learn as a professional trader to sit on your hands. And also you need to learn how to take losses. Very, very important. If you get in here and you see the market is clearly not agreeing, you have two rejections here where the bears are still coming in, driving the price lower, then you need to get out of the market, protect your downside, wait for the second chance. The second chance came, and in this case, the market went against you immediately again as well, but it stayed above the previous highs. So now the market has a new trending structure, higher highs and higher lows. Very, very clear structure now in place. And here the market never broke below the previous high point. So it's the trend structure really stayed intact. And this is how you can build confluence factors, and how you can build, or how you can use different criteria to have confluence in your trading approach and to find more sophisticated and stronger trading ideas.